Welcome to another video lesson from Sketchnest.com. I'm Brandon. Let's jump right in. Today we're going to be talking about the 5-year ARM loan, or what is also sometimes referred to as a 5-1 ARM loan. And in just a moment you're going to know what these numbers mean and how they relate to you as a home buyer. A 5-year ARM loan, or a 5-1 ARM, is actually a hybrid mortgage loan. And what this means is it combines properties of both a fixed rate mortgage loan and an adjustable rate mortgage loan. So with the 5-year scenario, during the first 5 years of the mortgage loan's term, the interest rate will remain fixed. This means if you start with a 5% interest rate on day one, you're going to have a 5% interest rate for the entire first 5-year period. This is the fixed rate period of the adjustable rate mortgage loan. At the 5-year mark and every year thereafter, the interest rate on the adjustable rate mortgage loan is going to adjust. That's why they call it an adjustable rate mortgage loan. So it's fixed up until this point, and then after that it starts to adjust every year, and it'll probably do something like that. Adjustable rate mortgages generally adjust upward, meaning that the rate will rise after the first adjustment period, which is right here at the 5-year mark. In certain rare cases, the ARM loan might actually adjust downward after the initial 5-year period, but this is rare. This is what's happening right now because interest rates are so historically low based on government stimulus and other factors. So people with fixed rate ARM loans that might have a 7% interest rate are actually seeing their fixed rate phase go downward after the 5-year adjustment. But like I said, this usually doesn't happen. What typically happens is that the interest rate will rise after the 5-year adjustment, after the 5-year fixed rate period expires, and the rate tends to adjust. So this is the adjustable period after the 5-year mark. You might wonder, why do people use this type of mortgage loan? Well, if you're going to sell the house or refinance within this window right here, then it might be a good type of loan for you to use, because an adjustable rate mortgage loan typically has a lower interest rate during this fixed year period than a traditional 30-year fixed rate mortgage loan. So you're looking at a 5-year ARM loan and a 30-year fixed rate mortgage loan. The initial interest rate is probably going to be lower on the 5-year ARM loan than it is on the 30-year mortgage. But remember, that's only for the initial 5-year period. After that, you don't know what it's going to do. Your rate is going to be tied to a certain index, which is a market condition, various lending trends and market conditions that we don't really need to get into here. But your rate is tied to an index that is going to make it adjust. It will probably adjust upward. When your rate adjusts upward, so does your mortgage payment. So your mortgage payment will increase if the rate increases after the adjustment period. But if you can sell the house or refinance within this 5-year fixed window, you could save money by enjoying that lower interest rate, and then you could avoid the uncertainty of the fixed rate period, or avoid the uncertainty of the adjustable phase by selling or refinancing the home. However, if you plan to stay in the house for a long time, 10, 15, 20 years or longer, this type of mortgage loan can be risky. If you're unable to refinance for any reason, perhaps your home equity drops, or your credit score is bad, or your income is insufficient for refinancing, then you are stuck with this roller coaster ride. You're not going to be able to refinance, and if you're not planning to sell the house, then you're just going to have to deal with yearly adjustments. Every year your adjustment rate, your interest rate will change, and you just don't know how much it's going to adjust. Ask about caps. If you're planning to use an ARM loan, you need to find out about caps. Most ARM loans have a lifetime cap. Some of them have a monthly cap as well, and this limits the amount that the ARM loan, the interest rate on the ARM loan, can raise from one period to another, and sometimes over the entire life of the loan. So ask about that information. And when you get a quote for one of these loans, an ARM loan, if you plan to use one, be sure that you look at the good faith estimate or the GFE, because GFE, not A, GFE, good faith estimate. This will tell you how much your rate could rise at the first adjustment period, and that's obviously something that you want to know. I hope you've enjoyed this lesson. If you would like to watch more videos like this one, you can visit us online at www.sketchnest.com. Thanks for watching.